Look at almost any wealth-building forum, you'll find the same core advice. Buy a house, rent it out, and let tenants pay off your mortgage while the property value climbs. It is treated as a reliable path to generational wealth. The math looks incredibly compelling when you lock in the perfect conditions. Imagine buying bank-owned foreclosures for less than $60,000 at the market's bottom and locking in fixed 30-year mortgages at 3% interest. This chart shows how those early investments scale over a decade. A property purchased in 2011 for roughly $60,000 eventually hits a valuation of $400,000. On paper, that is a gain of over 300%. But equity in a property is illiquid. That multi-$100,000 figure only exists as a projection, and you cannot spend a single dollar of it until you successfully extract that cash and deposit it into a real bank account. To see how much of that wealth actually survives, we need to take a multi-million-dollar real estate portfolio and audit the real-world performance, looking past the gross numbers to see where the money actually leaks out. When you only look at the purchase price and the final valuation, you blind yourself to an array of operational costs and tax penalties that can hollow out a portfolio's profitability from the inside. Maintaining a rental portfolio day-to-day reveals financial pressures that standard real estate projections rarely account for. Many independent landlords decide to keep rent well below market rate for good tenants. The logic is that keeping a tenant happy guarantees they pay on time and prevents the expensive headache of turnover. But the 2020 economic shift changed the math. While the city of Los Angeles imposed a 3-year ban on raising rents, the underlying costs of ownership exploded. Insurance premiums doubled, repair labor rose by 50%, and utility bills climbed by nearly a third. This formula illustrates how investors value properties based on annual income. Because the rent was capped by law, any future buyer would see a lower potential yield, effectively slashing the property's market value by $100,000 compared to its neighbors. Then there is physical maintenance. Investors are advised to budget a steady 1% for annual repairs, but real-world maintenance is lumpy. A sudden $20,000 bill for a failing roof and AC can wipe out the entire year's income for that specific property. Between the permanent loss of resale value from low rents and the catastrophic nature of repairs, the equity that looked so strong on a spreadsheet begins to erode. Eventually, the owner decides to exit the market. But selling a rental property is a high-friction event that requires significant liquid capital just to begin. To secure the highest price, a landlord may need to spend over $100,000 across multiple properties on renovations, staging, and even voluntary buyouts to ensure the units are delivered empty to the new buyer. Once the sale is finalized, the IRS collects. For years, the owner used depreciation to lower their taxable income, but upon selling, they must recapture those deductions, paying the government back at a 25% rate on top of state and federal capital gains taxes. This doesn't even account for the hassle factor, the dozens of hours spent managing municipal inspections, insurance renewals, and compliance registries that drain mental energy every month. Liquidating the portfolio triggers a cascade of delayed tax bills, renovation costs, and administrative friction that silently consumes a massive portion of the gains. When we combine all these factors into one final, sobering calculation, the reality of the portfolio's performance is revealed. After subtracting the 6-figure hit to resale value, catastrophic repair spikes, exit preparation, and tax recapture, the net return drops to roughly 4%. That yield equals the return of a risk-free treasury bill or index fund, requiring 0 phone calls or contractor negotiations. To survive in modern real estate, an investor must be unemotional. They have to raise the rent to the maximum allowable limit every single year and budget 50% more for repairs than they expect. Physical real estate still offers opportunities for those who are willing to treat it like a demanding part-time job. But for many, the trade-off in time and liability is no longer worth the thin margin. If the goal is truly passive wealth and peace of mind, the frictionless compounding of a simple index fund is often superior to the physical, bureaucratic burden of property.